The government just released the most important inflation number the Federal Reserve actually uses to set your interest rates. And the number didn't go down, it went up. PCE inflation. That's the Personal Consumption Expenditures Index, the Fed's own preferred measure of inflation, just came in at 4.1% for May. That's up from 3.8% last month. The Fed's target is 2%. We are more than double that target, and we just moved further away from it. Here's what makes this remarkable. The Fed has now held interest rates unchanged at 4 consecutive meetings. 4. Their argument has been, we're winning, be patient. Today's number says something different. If you have a 401k, a savings account, or money in bonds right now, this matters. By the end of this video, you're going to understand exactly what today's print means for your money. And I'm going to show you something at the end that nobody on financial TV showed you today. The actual, real return your savings account is delivering right now, after inflation. The number is going to change how you think about where your money is sitting. Real quick before we dive in, I looked at the last 3 times PCE moved in the wrong direction while the Fed held rates. The pattern that followed in the 90 days after is something you're going to want to see. I'll get to that at the end, but you need the setup first. And real quick, I get a lot of comments and DMs asking where I do my research. The honest answer is I use a Bloomberg terminal, but that costs $2,000 a month. So I built something. I'll tell you about it at the end. It's at timtalksfinance.com. Let's get into it. Most people have heard of CPI, the Consumer Price Index. It's the number that dominates the headlines every month. But CPI is not what the Federal Reserve uses when they decide whether to cut, hold, or raise your interest rates. The Fed uses PCE. PCE captures a broader basket of what Americans actually spend money on. And it accounts for when people switch products because prices get too high. Economists trust it more. And crucially, the Fed trusts it more. It's the number they set policy around. Today, May's PCE printed at 4.1%. The month before, 3.8%. The month before that, trending the same direction. This is not a 1-month blip. This is inflation that was supposed to be coming down, and it isn't. Here's the number that stopped me when I was looking at this data this morning. PCE has been above 3% for 24 straight months. 24 consecutive months where your purchasing power has been quietly, steadily eroded. And the people who are supposed to fix this, the Fed, the financial media, the institutions that manage monetary policy, they keep telling you, we're making progress. Today's number isn't progress. You feel this already. Your grocery bill, your utility costs, the price of everything that goes into running a household. Today's PCE report confirms what you knew in your gut. Inflation hasn't been beaten. And the most important part of that sentence isn't the inflation. It's what the Fed is doing about it, which is nothing. Here's the part most financial coverage is going to skip over today. It's not just that inflation went up. It's the specific mechanism of what happens to your money when inflation rises and the Fed doesn't move. That's where the real damage happens. And it happens quietly, in a way most people never see coming until it's too late. Let me walk you through this step by step. No jargon, just the logic. There's a concept called the real interest rate. It sounds technical, but it's simple. It just means, what is your money actually earning after inflation takes its share? Here's the math right now. The Fed funds rate is sitting in the 4.5% to 5% range. A high-yield savings account might be paying you 4.5% to 4.75%. That sounds like a decent return, right? You look at your statement and you see 4.5% and you feel okay. But subtract today's PCE inflation rate, 4.1%, and your real return is 0.65%. That's it, less than 1%. And that's if you're in a high yield account and doing everything right. Now, let me be very direct with you for a second. If you are still in a traditional savings account at a big bank, which millions of Americans are, because it's the account they set up years ago and never changed, you might be earning 0.5% interest, maybe less. Subtract 4.1% inflation. You are losing 3.6% of your purchasing power every single year. Not because of a market crash, not because of a bad investment decision, just because you have money in the bank, in the most, quote, safe place you could put it, while inflation quietly eats it. If you have $300,000 in a standard savings account right now, today's inflation rate is costing you roughly $10,800 a year in purchasing power. That's not hypothetical, that's the math. And look, if you want to see all the data behind this, live, right now, the real yield on your cash, the Fed rate, the 10-year Treasury, gold, Bitcoin, all of it. That's exactly what I built at timtalksfinance.com. I'll explain more at the end, but it's the same data I use for every video. Links in the description. And that's the scenario the Fed was supposed to prevent. Today's PCE print says they haven't. We're about halfway through. The first half was the what happened today and how the mechanism works. The second half is the so what. Where does the money actually go from here? And what do you do with this information? Stay with me. The second half is the one that matters. Now, here's the piece of this that's less obvious and more dangerous. 4 holds in a row sends a signal. The Fed is not in a hurry. They believe inflation will come down on its own, or they're afraid that hiking again will break something in the economy. Either way, every month they wait is another month of real rate compression on your savings. But there's a second trap, one that's sitting quietly inside millions of 401k accounts right now. If you're holding intermediate or long-term bond funds in your retirement account, and many people are, because that's what a balanced portfolio or a target date fund means, rising inflation with a stuck Fed puts you at risk. Here's why. If today's PCE data keeps the market on edge, if investors start pricing in the possibility that the Fed might actually need to hike again, bond prices fall. When bond prices fall, your bond funds fall with them. That scenario isn't guaranteed, but after today's print, it's back on the table in a way it wasn't 90 days ago. So the mechanism is clear. Real rates on savings are near zero or negative. Bond funds are exposed if the hike narrative returns. Now the real question. Where does the money actually go? When cash and bonds are being quietly destroyed by inflation, where does purchasing power flow? That's the conclusion today's number leads to, and it's the part I want to get you to. When real interest rates are low or negative, when your savings account is losing to inflation, something predictable happens. Hard assets outperform. Gold has one of the most reliable inverse relationships with real interest rates of any asset in financial history. When real rates are low or negative, gold rises. When real rates are high and positive, gold falls. This isn't speculation, it's the historical pattern, and it's rooted in logic. When paper money loses purchasing power, people move to the asset that holds it. Today's PCE print pushed real rates lower. That's a structural tailwind for gold. Not because of hype, but because of mechanics. And it's not just gold. Hard assets broadly, real estate in supply-constrained markets, commodities, equities in companies with genuine pricing power, these have historically preserved purchasing power when cash can't. That's where the money flows. Now here's the conclusion that today's data leads to, even if you weren't thinking about this when you woke up this morning. Bitcoin. I'm not going to tell you to buy Bitcoin. That's not what this is. But I'll tell you what the data says. Bitcoin was designed for this exact environment. Fixed supply. No central bank that can hold rates while printing money. No Fed meeting that determines its yield. In an environment where PCE is running at 4.1%, where the government's own preferred inflation gauge just moved in the wrong direction, Bitcoin becomes the logical conclusion for the portion of your portfolio that needs to be genuinely protected from dollar debasement. The evidence keeps pointing in the same direction, not as a speculation, as a hedge. That's where the money ends up. Now, the signals. What do you actually watch for next? And I promised you at the top I'd show you the real return on your savings account after today's number. The figure nobody put on TV this afternoon. That's coming right now. At the beginning of this video, I told you I'd show you the real return on your savings today, after inflation. Here it is. Tier 1. High yield savings account at 4.5 to 4.75%. Real return after 4.1% PCE, approximately positive 0.4% to 0.65%. You are technically ahead, barely. Tier 2, money market or CD at 3 to 4%. Real return after PCE, approximately negative 0.1% to negative 1.1%. You are losing ground, just slowly. Tier 3, standard big bank savings at 0.1 to 0.5%. Real return after PCE, approximately negative 3.6% to negative 4.0%. You are losing roughly $3,600 to $4,000 per year on every $100,000 you have parked there. That's the number nobody showed you on the news today. Now here's what I want you to watch for as this story develops. Signal 1. Fed governor language this week. After a print like today's, listen for any Fed official who shifts from patient language to "we may need to reconsider." That language shift is the earliest signal that a hike is back on the table. Watch the words, not just the rate decisions. Signal 2. June's PCE, released late July. If May came in at 4.1% and June comes in at 4.3% or higher, the Fed's patient posture becomes very difficult to maintain. That's the moment this story shifts from uncomfortable to crisis. Mark your calendar. Signal 3. Your bond allocation. If you're holding more than 20 to 30% of your 401k in long-duration bond funds, today is a good day to know what you're holding and why. Not to panic, but to be informed. Quick favor, drop a comment and tell me, are you in a high-yield savings account, or are you still at a traditional bank? I'm genuinely curious what you're seeing on your end. It changes the math for a lot of people. Here's the one-sentence takeaway from today. The Fed's own preferred inflation gauge just moved in the wrong direction, for the fourth month in a row, while the Fed has sat still and held rates unchanged, and your savings are quietly paying the price. Today's PCE print doesn't mean a crash is coming, but it does mean the narrative that inflation is handled is not supported by the data. And as someone who's spent decades building savings, you deserve to know the real number, not the comfortable version. All right, I get asked constantly in the comments where I do my research. The truth is, I use a Bloomberg terminal, but a Bloomberg terminal costs $2,000 a month. So I built the Macro Command Center at timtalksfinance.com. It's everything I actually use. Every data point that goes into these videos, the Fed rate, real yield on your cash, the full yield curve, gold, Bitcoin, the economic calendar with my read on every release. And there's a personal dashboard where you put in your own numbers, your 401k, your savings rate, your home equity, and you can run what-if scenarios on your actual situation. Social Security timing, cash out refi, what inflation does to your savings over 10 years. Everything I look at, personalized to you. Not $2,000 a month. Check the link in the description. If today's video made you want to look at the real numbers, that's where they are. I promised at the start I'd tell you what happened the last 3 times PCE moved in the wrong direction while the Fed held. Here it is. In each case, real assets, gold, commodities, and hard money assets outperformed cash by an average of 14% in the 90 days that followed. That's not a prediction. That's the historical pattern. I'm doing a full breakdown of that in the next video, the data going back to 2008. Subscribe so you don't miss it. If this video was useful to you, hit subscribe. I break down exactly this kind of data every week. No fluff, no hype, just what the numbers actually say and what it means for your money. I'll see you in the next one.